Hey guys, everybody joining. Great to have you here. We are gonna wait a few more minutes, I believe, to get everybody in.
Hello,
Jaime, hey.
everyone. Hi, Lucas. Good to see you there.
I just joined. I already see the people coming in.
I can't hear you, but I don't know if it's me. It may be me, in fact.
You cannot
One
hear me?
second. Can you speak now?
Yeah, hello, now?
It may be me.
Daniel can hear.
Let me check. Okay, I think now it's ready. Can you try?
Yeah, let's do again.
Great. Yeah, it was
Perfect.
on me. Okay, well, we'll give it 3 minutes, I think, until we get started. That there's always some people joining with a bit delay. But yeah, and also I'm going to add a different background. So yeah, we plan to start at like 5:33 hours.
Yeah, I think it makes sense.
Perfect. Great.
As far as I understand, the Spain electricity is back on, so I hope that is not keeping people from coming.
That's true. I mean, it was crazy. I think I was one of the latest people to get it back this morning at 10:30. So it's been 22 hours, but yeah, it's been the end of the world here. Like people react weird when they realize that they lost Wi-Fi and signal at the same time, including me, by the way.
Yeah, we are quite dependent, right? Everybody in front of their laptops ready to make some business, but when the internet turns off or the energy, yeah, that's another story.
Exactly. It's like to me, it's like okay, every now and then we've had a power outage in the office, and the world keeps turning, or every now and then you may lose signal for a while, but like the combination and like half hour gone and like things not changing was a bit scary. But anyway, fortunately, I mean, as far as like people I know and people on our office and their families, like no one had a big deal of like missing something very important or a medical emergency or anything. So luckily, yeah, like we shouldn't like lament too much. Now it's just everyone thinking like, what the hell happened? But that's a longer story.
Yeah, absolutely. I see we are also filling up. That's nice. Like initially, a lot of people brought their note takers, and it was 4 people and 4 note takers. So that software is definitely hitting.
Yeah, perfect. Yeah, we're successful among not takers. So, but perfect. It's 5:33, so I think I would get started. So, thank you very much for joining, all humans and all note takers here. Happy to be here with Lucas from Recap. I'm gonna do a brief introduction on myself and on the Startup CFO. The company started 5 years ago, and then let Lucas do the same. And then we're gonna jump into the topic, which is on understanding the financing landscape, master your capital, idea and funding and liquidity setup for tech companies. And we are gonna check how there's so much more than equity. And in fact, equity should be used for the right use cases, which are not all, and with its risks and with its downside properly understood, and the alternatives should be taken into account. So, well, on me, I'm Jaime Medina. I studied physics, but long ago. Then I continued my career in business. As I worked in McKinsey in consulting for a couple of years, and then is when I switched to the startup world in the finance area. And that was over 8 years ago. And since then, I've always worked in finance and in startups, but from different points of view. So at the beginning, I started working as a full-time employee, as CFO of startups, but then I switched to do freelancing to start working for several startups at the same time. And then since 2020, as a company and trying to scale the business, having a team ourselves that we could serve our clients. What we do in the Startup CFO is fractional CFO services to startups or small tech companies in early stage that still do not need a full-time CFO on board. Usually the CFO is the last member of the management team to join the company. And of course, at some point, a full-time CFO is needed. But until then, we are the ones that help them with fundraising, with reporting, strategy, KPIs, admin issues, everything of that. I always say that we are the guy that if you had a CFO on board, you know what tasks would you give to that person. So that's what we take care of. And we are already a team of almost 40 employees and with clients in over 20 countries, I think. And yeah, please, Lucas, that you will do a better job introducing yourself than if I do it.
Well, I think you did that well, and you're in the right spot here, having the financial background. We actually at Recap we hired the CFO as one of the earliest people we needed because it's quite a capital intensive business, and we needed to make sure that we set up the financing background and have all the money at hand. But therefore, all our processes are actually quite advanced. You know, I've been a startup person my whole working life, and I think we are probably one of the best setup I've seen so far personally when it comes to our own internal finances. But I think that's the least you can expect when we want to help other people manage their liquidity. So yeah, my own background, as mentioned, I would say I'm a startup soul. So after graduation, I started working in startups, first in sales in software, and then quickly understood that I like making good deals. So understanding which person would be interested in what type of product actually. So first of all, not really funding related. So I did software 2 years, doing a go-to-market there. Actually, I've always been doing go-to-market. So my fourth station here at Recap. So first software, then FMCG, something completely different. Food at that time, quite a long time ago. Then I did real estate financing for 4.5 years, and also as a platform. So there's a relation to Recap already, and now with Recap for 3 years. And myself, I'm responsible for everything customer. So basically making sure that people who are looking for funding get the education they need, identify if what they are looking for is what we actually provide. And if I get that understanding that is a match, then I try to also give that person the same understanding, right? And in the end, together with my teams, form a good portfolio of companies that we provided funding to. So more of the Recap side, in all shortness, yes, we are here because we provide alternative debt, but we are more of a data company. So we understand the platform as being the capital operating system for a company, which basically means you provide the CFO services. So a lot of the services that you need to have early to kind of get your financing your financial processes under control. We would deliver the software that helps you actually achieve that. So some of the work that a typical accountant would do could be done through our platform because it analyzes cash flows and based on that understands what the actions should be, or you can understand what the actions should be based on your cash flow analysis. And from that platform and from that understanding, so basically using raw data to assessing company quality, we are able to assess if we should provide funding to that company. We do use a few data sources more, but in essence, that's what we do. So providing a platform that on the one hand gives you the access to funding, but on the other hand also to the insights, what you could use that funding for. And myself, I would say deep customer mindset and try to make both parties happy, let's say.
Perfect. Yeah, I mean, I think that's part of your success, and we'll discuss it later. But how, like in a business like lending money, which is pretty old, you guys can do like something that would look very aggressive to banks and still have great results for both the customer and yourselves. And I guess data is the answer, and like the handling of data. And one last question, personally, like what inspired you to join Recap and like focus on this specific like part of this alternative financing? Because I understand that you were on more traditional sources of financing. So what attracted you here?
Yeah, to be honest, I think that actually my first decision was made towards the team. So whenever I think about that, the first thing I look at is the management team, and if I think they're capable of achieving what they're looking to achieve, and if I can actually help with that. So that was my kind of first decision-making point. But when it comes to the actual business model, what struck me most, to be honest, initially was not the funding itself. I think money can be interesting. It depends on how complex the use case is, and money can also be very simple. So I think I personally believe if you're in a commercial role like myself, I like complex products and challenging products so that it doesn't get boring. And I think that's the case here. If you finance companies on a day-to-day basis, you discuss their situations with the CFO, the founder, the CEO. I think that's what really triggered me, plus the combination of having the data analysis and therefore being able to finance companies that were not really financeable before, at least in Germany, right? We have and I think that in Spain it's partially the same. Banks are very, very defensive when it comes to, or like averse when it comes to companies that don't have typical like assets or profitability. So I think using data and offering this platform to understand the quality of a business and actually making it financeable, that kind of convinced me the most that it's actually something groundbreaking, right? Just having money and giving it to companies nobody was giving it to before. There needs to be a solid background of this. And I really think the platform is super strong. And that's what kind of convinced me in total.
I see. Yeah, I guess like in early stage, and I consider early stage like pretty long. The team is what matters, certainly, and then yeah, like the part of the impact on like these companies weren't financed, now they're financed. And by the way, you proved your point that they had to be financed because you guys have a sustainable business model yourselves. That is absolutely wonderful. By the way, before we jump to like the main topics, just to remind everyone in the audience, feel free to ask any question, just unmuting yourself. I think we're not too many, or use the function raise hand in Zoom, write it on the chat. That may be the easiest. I have it open, so if any of you guys write any question, we'll bring it up in real life. So okay, jumping to the topic. So I think like if anyone thinks of startup financing, we are like in headlines about this startup raises X million Series A, or In fact, I remember like having to explain to my father, who has worked in finance many years, what the hell like raising a Series A meant, and I was like a capital increase. But anyway, so okay, we are used to that. What are the pros and cons of that? Like I have my own answers, but yeah, like from your point of view.
Yeah, I'm obviously interested in yours, but I will shoot first. So first of all, I would say that 70% of our current portfolio is equity financed. So did go the at least angel, mostly VC route, and 30% would be bootstrapped, plus maybe very small angel investments, which you can still consider bootstrapped, then probably. So there is a strong bias towards externally financed companies because those are typically cash burning for a long time and therefore not bankable, right? What we observe is that in the bootstrap space, if you don't have a lot of cash at hand, you get creative and you actually make yourself bankable over time, right? Even though it's smaller amounts, but you also need smaller amounts. So I think if you look at the pros and cons of equity in general, I would say that the first thing is to ask yourself if you actually want to pursue that route, because I think in the early stage when you're considering angel investments, it doesn't come with a big loss of control. It mostly rather comes with like increasing your network, increasing your reach, getting ideally good people from the space into your space, into your company, and getting them to help you. So I think there's a very good kind of relation or combination of getting funds, but also getting the expertise and the network. But I believe once you do actually enter that VC route, it comes with expectation, right? And you have to be very aware of what you're getting into, because well, 10 fundraisers, one unicorn, and 9 companies that probably are written off, right? So there's the expectation towards growth. And I think especially in the current times, and we're probably going to get into that, it's important to see that also this can shift, right? What VCs expect from you can really shift depending on the kind of situation in the market that you see, and this can go very rapid. So I think there's not the one clear answer, but I think first of all, be clear of what you want to achieve. Do you actually need to raise equity? Or can you also pursue it with alternative options? I think that first decision is most important. But what do you think in general, what to consider there?
Perfect. Before I reply, I'm gonna be true to my word that I see a question in the chat. It directed to me, but like you guys can direct it to me or to the public in general, which is for you. What is the right stage for recap? Is it relevant for pre-revenue, deep tech, long R&D?
Sorry, right time for recap, right stage?
What is the right stage for recap financing? And if it's relevant for pre-revenue startups, that it can be deep tech or that have long R&D or stuff like that.
Yeah, so first of all, we can't yet finance pre-revenue startups. So it's not the right time at that point in time, but I think it's the right time to know about all your options, because if product market fit kicks in and you start selling the product and you start generating revenue, that is usually where also considering alternative funding already makes sense. In general, maybe we will touch a bit deeper on it later down the road, but or we definitely can. It is all about planability. If you take debt, recap or any other debt, you have to pay it back at some point, right? It doesn't really matter when for now, but you will have to pay it back. So ideally, the investment you want to take using that money is quite predictable, so that you will come to a position of being able to repay that. And I believe the more mature the company, the more clear that path of how do I actually repay the money in the end is going to be. But if you are super mature, so let's say if we stay in the VC context, Series C or plus, then usually why would you work with somebody like Recap? Because our tickets are maybe too small for what you need if you actually need money. Like we do have some companies in the area of 50 million annual revenue, but that is usually then really optimizing the capital stack. That is not very essential funding for the survival of the company. So that range, I would rather put it to ARR is probably 1 to 10 million would be the sweet spot of where to use a funding like ours.
Makes a lot of sense. Again, you guys feel free to write any question on the chat. Regarding the pros and cons about the equity funding, I think only on that we have the risk of taking up the whole time of the webinar. I would say that, well, many things here. Like, first of all, is like there's no 0 or 100 answer. You know, there's combinations as well. Like, and I always give the same example. It's like if Uber wants to open their first city in San Francisco at the beginning, of course you need to fund it by equity. Like no one is gonna take that risk of funding a project that so ambitious and that no one has ever done before if they are not gonna share the profit. Like you don't give someone $1 million for a project that you have no idea how it's gonna go if your downside is 1 million and your upside is 4% of that. But what about the city 1000 of Uber? If they have proven, again, this is a mental experiment, not like with precise figures. But what if they have proven that the first 1000 went profitable? You know, would you fund the 1000th with debt? Probably. And then in between, maybe the combination is 90-10, 80-20, 70-30, and then the risk gradually keeps going up. I think obviously on the repayability of the debt, I think that's both obviously a problem for the lender and for the company that doesn't want to find itself in a situation that they cannot repay back a loan. I think that for many people, and we see it among our clients, debt is just like no way because I need to repay it, and then like on equity they are much more like they think they're more risk averse by giving up equity because they don't need to repay it back. But then there are many ways to repay back equity, like for example the liquidation preference, and this is beyond Series A. almost a must in every single round. And that is a way that, okay, like whatever profit like your company will bring to the shareholders first needs to go to the guys that gave you the money in the form of equity. So so that's certainly something that I think it's often overlooked. And also a big point, I like the sentence you said, that is that certain angel investing, like friends, schools, and family, you can consider it as bootstrapping. And I always say that many startups, they should think first, or many companies, if they want to follow the startup path or not. And I think it's a matter of, is your product the product is a product that maybe has low margin or very long R&D, like in the question, like deep tech, a very long R&D phase, something you need to finance, and so that you need that type of financing, does it fit? Because if you want to build a house, you don't need equity financing, or you need a lot of debt financing, and that's totally fine. But it depends a lot on the company. I think many times people start a startup that does one round after another when they should have got a bit of money from business angels, and that's it to get started. And I really think that it seems now that you open a bakery in the middle of Madrid, and then it's like, how much money are you burning per month? When is the Series A? You know, and it's like, no, like it depends on the business. And in my opinion, also a human part of it. Like, are you willing to share, like you said before, are you willing to share the risk-reward profile of your investors? Like the VCs want one possibility in 10, for example, of you being super successful, even at the expense of 9 out of 10 of writing off the project, which is fine, by the way. There's nothing bad with that. But like, if you want one chance in 3 of doing all right, don't go with a VC that wants 1 in 10 that you do amazing. So on that is also like many people miss, in my opinion.
And actually, our target group for alternative debt is the 9 out of 10. So not the rocket ships. The rocket ship needs too much money. They need too much fuel to like keep flying. I wouldn't exclude that completely. Obviously, we would finance those companies, but I think more solid use cases. Like usually, when you look at it, and maybe before we touch, because we will touch the alternative debt, I had one topic in regards to the liquidation preferences, which I think is super valuable for everybody to consider, especially when you haven't raised a lot of equity rounds and you don't have the experience in what to look out for, right? Because a 300 million exit can give the founders and the team way less cash than a 40 million exit, because the one has a lot of and very high liquidation preferences to bad conditions, and a lot of money goes to the VCs first, right? So I think apart from the valuation that you achieve when raising the equity round, it's super important to, first of all, I believe, and I have to steal that one from our Recap founder, Paul. He always says, well, let's say in quotes, a no asshole policy when it comes to equity, right? I think generally, probably in business, it should be the same, that whoever you work with, you should want to work with. And especially when it's a VC that's sitting in your board, I think it's super relevant that you see that they have a honest intention and that you click with them personally. I think that's super relevant because every startup will go through ups and downs. And I think it's for Recap as well, basically for a debt provider, any debt provider, the good phases and the bad phases. It's important how you behave in both, right? And you as a founder that took the money, let it be VC or let it be debt, or let it be equity or debt, you basically have to work with that, right? And that third party that you get in the picture. So I think that's super important. And then on the liquidation preferences, do you actually, Jaime, do you have examples from your portfolio maybe where you know, okay, there was a super impressive exit that you can share or something?
Yeah, I mean, we've had good exits that I can name, and I guess the best one ever, and it's gonna be the best success story of our clients for ages, is Kobe. Kobe is a startup that about like for big corporates or even for SMEs to handle the company benefits for their employees. And Kobe was sold like really successfully, and of course the liquidation preference didn't matter because everyone was very happy. However, We also have some other cases that I will not mention, which you can see in the newspapers and on LinkedIn, huge headlines on like what a wonderful sale, and you know that the founders got literally zero. You know, so this is like okay, and also by the way, in many cases we see founders that regardless of how they do, they regret having raised too much equity in the wrong time, and this is from several angles. Like I think it's a vanity metric. Like you want to say that you raised 15 million rather than 4 million. It just sounds like a better achievement. And of course, there's a lot of effort behind it. However, many companies come to us and say, we want to, I want you to build a business plan for the coming years so that we need to raise 15 million. And we are like, no, this is the other way around. You know, tell me what you want to achieve and I'll tell you how much money you need for it. And the problem with raising too much is, first of all, it tends to create a bad culture in the company that I think, and you mentioned before, that like non-VC companies or companies with debt tend to be much more rational. So if a company raises too much, they start spending way too much. And second, it raises the valuation, which by now is all right and it's less dilution. But 2 years down the road, it can really hurt you because the multiples usually tend to rationalize in time, and then having a too big, a too high valuation at some point, then it's a problem down the road for the next round, and it's like, okay, you didn't meet the expectations. So certainly there are many on like, okay, equity is fine, but absolutely. In my opinion, and I don't know, like if you have like a specific definition, like it's like on when is the right time. But I clearly think that there is a right time and there is a wrong time for equity.
Yeah. In my view, it all from because I clearly have a lot of the debt perspective. So for me, equity, I always when people finance very plannable outcome with equity and they already have options on the table, I would think that they were not educated properly. So it really comes down to, can I finance this without dilution or not? Because I think that's probably one of the bigger misconceptions. You've been speaking about like rather raising 15 than 4 million because it sounds nicer, and I totally agree that that's the kind of sentiment. But it's also the question of do I need to raise equity for this, or can I actually can I do it without any further dilution? And I think especially for companies in the target group we are looking for, so 1 to 10, 1 to 15 million ARR, probably not the rocket ship as mentioned, but substantial in revenue. There is alternatives usually, and you can try to predict as good as possible what you're going to do. And those types of companies that do not go the crazy hiring route, for example, like you mentioned, right? Where you raise a lot of money, you have to hire crazy amount of people and it gets out of control a bit, right? I've been part of that as well. We've been in my last company growing from 70 people to 220 people in like 1.5 years, which was like for me as well. I had to sometimes in one quarter hire 4 people in like sales. And how are you going to be able to hire 4 AAA players at the same time with, I don't know, 20 applicants that you interview or something, right? It just doesn't make sense. So we really see that in the market for companies that are not that crazy rocket ship that just raised a crazy VC round, it's way more kind of down to earth situations where they ask the question of equity versus debt. And those situations are usually, I have a certain amount of revenue, I have a plan A. That plan A is maybe my next round. It might be the Series A, Series B, right? But I need a plan B. Also, my existing investors ask for that plan B. They want to see how I can become profitable. Like a question probably 3 years ago, nobody really asked when investing, right? But now they do ask it. And nearly every business needs to show also that plan B, how they can become profitable, where also investors and like equity and debt is not necessarily in that case a this or that situation, right? Where you choose the one or the other. A lot of VCs are actually multipliers to us because they know that if we provide money to their portfolio companies, also their shares do not dilute. So like before they invest, we are competitors. After they invest, they are multipliers to us, right? So I think it's all about getting the money in for the less costs. And One, then what I wanted to get at, clear misconception is that equity is for free. I think that's actually something I heard a lot of times. In the last 3 years, I think I've been speaking to around 500 SaaS founders in that range I've just been describing. And you would wonder, especially in like 22 when we started, how many people said our money is so crazy expensive and equity is for free, and you were like touching your head like, no, maybe in 2-3 years or 4 years, 5 years, when you want to do your exit, you will see how much it costs. But that was super interesting. Now it's completely different, right? Like the market is way more educated 2-3 years later. I think you guys, as far as I know, you also are try to be quite active in regards to different funding options that you put out, right?
Yeah, it's our job. Absolutely. It's for us, like if we want to be good CFOs for our clients, we need to know all the alternatives and how the funding matches the purpose and the capital structure and everything. Which, by the way, regarding that, I was going to ask you exactly that. Have you seen in general, like how have you seen in general the debt market, debt in general, venture debt or alternative financing, like the market evolve in Europe in the last years? Because at least we have seen many players coming and going, being more or less active. So clearly something's moving, but I guess you have probably a better perspective than us, even if we try to catch up.
Yeah, I think first of all, there is a lot of movement in the market and there's a lot of players going in. Also, I also understand why a lot of players go out again, because the market is not very easy. It's exactly what I just described. It's all about how well educated are people. Like, is this actually an objective decision with like all the information at hand that is being made? Or are you missing information and just raise equity, right? Like it's actually a very hard market. It's not that competitive, I would say, in like each niche, like at least from our perspective. So if you take the like bigger known players in Northern Europe, I have to say that's where today we are most active. We are currently live in Germany, the Netherlands, and UK, and we're going to launch in Austria and Spain mid of this year. So, but from my market experience, we see that there's very short-term debt providers, which focus really on short-term liquidity need. They are usually a bit more lenient in regards to covenants and so on. They might give you money even if your runway is quite short. So it's really a let's put like a plug in the hole situation, where, or not a plug, but let's pour more money in, right, for the short term. So there's quite some short-term focused players out there, and where also we initially started with the idea of real cash flow optimization, right? So that you kind of, in the SaaS logic, that was our initial pitch, which now changed completely. But the initial idea was we go into the market, you have ARR, maybe let's say it's paid monthly by clients. You can pre-finance 1 year of ARR using our platform. That was our initial product. So you could say, okay, customer A, 100,000 ARR or maybe 10,000, pre-finance it, get all the money up front, and pay 10% discount to Recap. The same logic as if the customer would pay you annual upfront and you would give him a 10% discount. So that's where we started. But we really faced the problem that people weren't really thinking about like managing their cash that way. People thought about raising a big round of equity, spending it, and raising another big round of equity. And there's no place in that for optimizing certain cash flows or whatever. So, but that's the short-term area where it's really focused on short-term. What it's lacking is usually the long-term perspective. That you actually can use this to finance a solid long-term business plan, right? Then what we see, what has been coming to the market, and all of this new development is also accessible to smaller companies than before, because before you also specifically asked for venture debt, it was kind of solely venture debt, and venture debt was usually used to leverage equity rounds and kind of extend the runway after the equity has been used to a degree, and it was usually quite short term when it comes to interest only periods and so on. I would not really consider it a real debt product in how a debt product should be offered, right? It was also very complex in regards to contractual structure, and you had warrants and so on. So I actually believe in this mid-size, or let's say series seed to B. I think venture debt in our observation is going backwards a bit. It feels like, at least in the conversations we are having with companies in that group, from the software space mostly. And then you have new long-term players, which are we call it neo venture debt, but it's basically it tries to do the same, but it's without the equity pieces. I think that's already very good, right? Getting rid of another player that has like warrants is like a good thing, generally speaking. But those players really focus solely on the long term. So the idea is, okay, you might need 1 million or 1.5. You don't need it today, but you take it today. So the idea is, okay, really take 1.5 million today, keep it for 3 years, and then repay it over 2 years, right? So more like a typical classical loan. And now there's kind of us in the middle. I would say we're actually the only player that tries to fit in the middle. So we want to give our own kind of history flexibility of giving this short-term flexibility, saying, hey, I need 500K right now, and in 3 months I need 800K in total, and then I can reduce it because my seasonality cash flow is good. So we want to adjust to what you need. But we also want to give you the long-term flexibility. So we are kind of sitting in the middle. And I think that's what the general market landscape looks like right now for debt products. And yeah, going in and out, I actually think that has a lot to do with who those companies financed. So it's a question of how good are you in building a book and building a portfolio. Today, we can still say that we haven't financed a default. But this will come at some point, right? It's logical. We are growing very fast. We are financing a lot of companies. There will definitely be defaults. The question is your portfolio built in a solid way that you can actually handle defaults, right? And I think a lot of players that went out of the markets, either regulatory-wise in Germany, because Germany was very challenging in regulation-wise, but maybe also in other markets. To be honest, I'm more of a German expert when it comes to that. And
I have some comments on that. But yeah.
So Spain as well, maybe. But I think biggest problem to like cut that is the book, right? If you actually finance, if you build a book that you cannot sell, then you have an issue and you have to change your business model, kind of. And we see a lot of players, also big players, actually having to do that lately.
See, I mean, to me, well, several comments to what you said. First of all, I completely agree on the complexity of the venture debt, like, and how difficult it is even to compare among different term sheets, because it's not even just like the same terms but with different figures, but rather complete different structures. And that to me is something that, like, I don't know, like you need a PhD on financing, like, to really make sense of it, and that is obviously full, in my opinion, very often with hidden clauses and stuff that certainly funders should be aware of. Also, you mentioned in passing that you guys have had no defaults, and okay, it will come, but like, to me, like, respect, because you guys are financing companies, like you said at the beginning, that banks don't finance. Banks have been doing it for thousands of years. In fact, I think it's probably the second oldest profession in the world, like to lend money to someone else. So on that is pretty incredible to me. That's what I was saying in the intro. That's what I was saying in the introduction. Like, you guys have no defaults with companies that were non-financial, which is pretty incredible.
And
also,
I think
last
sorry, one comment on that. It's actually very funny because we are the platform, right? So it's not our money, it's the money of refinancers that trust the general process, right? And we are talking to other refinancers in general, obviously our ears in the market. And it's so funny to see how banks ask themselves the same question. And also because they want to understand, how do you finance that portfolio? But on the other hand, I think there's very good arguments to be made that a company that has a solid revenue base and a controlled cost base, let's say, there is a predictability to this, right? And if you then have also a board where you check that the investors that are already behind it have a certain level of backing for the company, I think there is very good arguments to be made for this, but it's just, and that's, I think, what's also so interesting about, because it is kind of groundbreaking, enabling companies to use money that, like, the typical banker, and we don't even see that changing at all, to be honest, right? Like, there seems to be no change in how banks approach this, even if there's digital departments in banks. That doesn't change that they don't understand how a startup works, right? For like cash wise.
Yeah,
But so
totally.
I didn't want to interrupt. It was just getting a bit executive,
No, that
excited.
makes sense. And there's a lot of inertia there. By the way, there's a question from Natalia. What is your perspective on equity versus debt from legal context in some countries? For example, in Germany, you can be easily classified as company in difficulties when you finance via debt and therefore lose eligibility for some state grants. Any experience on how to tackle that? This is very similar in Spain, by the way.
Well, I can start with Germany, and as we have a lot of Spanish people, you can maybe answer the same question for the Spanish market. To be honest, in our portfolio, we have not yet once encountered that issue that somebody raised money through us and later we got that information. So I can't really share that it's a known problem to me. I do know that I think it was in January 24, if I'm not mistaken, that there was in the media, it was quite present because it was about like the insolvency rules when you have to file for insolvency depending on your leverage, on your debt leverage, and so on. And in the end, this is not clearly defined as far as I know, when you have to do this and under which conditions you have to do this. So in our experience, as long as the business has now I'm missing an English term. I know there's some Germans in here. Maybe somebody can help me with Fortführungsprognose. But basically, the auditor has to say your business can keep going, right? As long as that's the case, usually we see no issues. And also then we had a company in difficulties. To be honest, we don't see that, but we have quite restrictive credit policy with our refinancer HSBC. So you can see that if we give you money, we check this because or we are certain that this is fine under the legal situation you are in. Because if we would give you money and we would not do our homework, and then it would be a problem for you, it would be a problem for us because we are not secured. So or very little secured. It's only receivables usually that is a security for us. But yeah, I hope that answers for Germany and Jaime maybe for Spain.
Yeah, I would say, I mean, I think the law is exactly the same, if I'm not wrong. Like, if I'm now looking for the words in English, if your equity is below half of what you have raised and stuff like that, then you cannot get grants. But we think that as usually this type of alternative financing, well, or almost always, complements equity financing, we don't see this type of debt becoming the problem, but rather sometimes the convertible notes. So if you do a convertible loan, then it's officially a loan. So then you're financing your company with debt rather than equity. And then you can get to very low equity or even negative equity, which is when the technical points of view, legal points of view, kick in. But I think usually for the amounts, we see more problem with the convertible loans than with this type of debt.
One interesting side note on that. When we analyze businesses on their leverage, equity versus debt, we actually view a convertible as 75% equity and 25% debt. Just side fact, because for us, usually it doesn't matter too much if somebody has a convertible or like a capital increase.
I think that's the right choice, or even to be honest, I mean, I've never seen a convertible loan being paid back. Never, not once after 400 startups. So to me, they are equity. But I mean, there are cases, of course, there are cases of everything. But
I remember around 5 people telling me they want to. So in like 1 or 2 years, I can tell you if they did.
yeah. I've seen one case that the guy wanted, but he would have bankrupted the company. So I was like, this doesn't make any sense. So converted in shares, and there was some negotiation, but like it's like okay, he wasn't gonna collect anything, so never mind. But yeah, I mean there can be a whole webinar on that. Anyway, and I'm always going slower than the script I had because we get in conversation, but I hope that's good. But how does recap financing work? Like, okay, like you guys are different than a normal bank financing. You have the best of short and long term, but the pitch of how do you guys actually work?
I think to keep it as swift as possible, I will actually try to use like 2, 3 images I prepared. I hope this works now. Let me see because I
If
didn't check.
not, I'll give now you can share.
Yeah, perfect. Thank you. So please bear with me because I'm a Google user usually. Do you see the screen with the slide?
I see it. Yeah.
Perfect. Okay. So,
Well, I see your, sorry, I see your desktop now.
oh, that's not what it's supposed to show. Yeah, doesn't that always create issues?
Yeah, 100%.
Now,
Especially
now
when
better?
now is the
Okay,
present.
okay, good. The right desktop. So basically, to keep it simple, I think this applies to a lot of different situations that you could face. So um, let's assume this white thing is the cash curve of the business, right? Still having a certain amount of cash, burning it, then having a certain zero line of cash, and at some point turning profitable and generating cash, and also getting the repayment capacity for the debt. So the recap product, basically how it works, you apply to the platform, you get approved by the platform with an initial, we call it funding plan. It would look something like this. It would show your cash development. It would show how much cash you need according to your own business plan. And FYI, we don't need a VC case, so just make it as conservative as you can, as long as you can hold it. That's kind of our mantra, right? Rather take 200K more than less and be safe. Then you're quite flexible in how long you can use it. So between 1 and 60 months. And then you can see here how it affects your cash balance, and here how you use the cash, and how much cash you could use according to the approval you initially received. So the general idea is, based on your revenue, we calculate how much money you can access. It's usually around 40% of your annual revenue in financing. So 4 million being 1.7, 1.8 something, right? And then that grows. So every month we calculate it newly. So if you give me a business plan where today you have 1 million revenue and next year you have 2 million revenue, I can already approve payouts for next year with 40% of 2 million. But you have to achieve your business plan so that I actually give you the money in 2 years, right? Then this is how Recap generally works. So in all ease, you just fill the cash gap as you need. If you look at the same, but look at it from from more of a long-term debt perspective, right? We talked about venture debt, we talked about other alternative debt providers. Usually this would be approached something like this. I try to model like roughly the same use case. You have a cash dip, you generate cash again. But the idea is then you raise the cash and then you kind of keep it very long. And it's usually a bit cheaper in percent, but it's very inefficient in usage. So the total costs are usually higher. So, and also the flexibility down the road, right? How do I actually change it? So in our product, it's more steered towards being flexible and making sure that that you can adjust to the situations that you face. And then equity obviously looks kind of the same, right? You raise the equity and so on. So what happens if now your plans change? And that is where I think our product has the strongest fit, because it can change in both directions. Like this was what you've seen before. Let's assume your company at this point in time, after 1.5 years of financing or so, you are being bought by another company. There's an exit. And or maybe you raise a big equity round and you want to get rid of our money because it's costing you cash every month, right? You can repay us. So it's very easy to get out because it's understood as a revolving loan facility. It's not a fixed debt contract that we have together. We do give you the commitment that all of this cash can be used. You will have to commit a certain minimum, usually half of the usage, maybe 30 to 50% of the usage you have to commit, but after that you are free to repay. There's a small fee, it's like 2%, 2.2 or 2.3% on the repayment, but then you can get out, which I've calculated hundreds of cases over the last years. This is like in the combination of flexibility and long-term security, we currently have a very strong market standing because you either get the one or the other, right? So this is how your regular case would look like. And then if you, let's assume you are at this point in time, you are actually repaying already, but you're identifying, I have a great opportunity to go to the US because one big player went out of the market and whatever, and you want to invest in that. And you also don't need to raise equity for it because you still have a very sufficient like kind of cash position and you have good revenue to show for financiers like us. What you would do is, now we see a different curve. We see you're generating cash, you could repay us, but you don't. Instead, you decide to keep the money longer, you decide to draw more money, and essentially also solve that new use case. So it's very flexible in how it adapts to the situation of your business. we have to say, and with this, I'm actually already done here. So, but we have to say, but you have to always show us that you are in control of your business financially. So just to give you an example, we need to see at least 6 months of runway before we start paying out. We are flexible in how we show the 6 months of runway. There's options. So it's not that if your bank account doesn't cover 6 months, it's an absolute no. For example, if there's investors that back you, that can be considered and so on. But you need to show us that you're in a general healthy financial situation. Same goes if you need more money later. That can be investing, but that can also be that maybe your market is really tough on you, right? And maybe your revenue is not growing as quickly, but you are still in a generally healthy position, but less healthy than you initially planned, and you need 500K more. Obviously not the best position to talk to somebody, but if you do it early enough and it makes sense and we understand how we will be repaid, we can also extend the facility. But it's all about the right timing. And I think that is a super important time in regards to also common mistakes in fundraising in general. Let it be equity, let it be debt. In my experience, people raise funds way too late or they start too late. So we see that whatever you do, if you raise debt and you have 12 months of runway, everybody in our space will want to give you money if you have a generally healthy business otherwise, right? But if you, same goes for equity. Like what we see is, like the worst thing you can do is being with your back against the wall when talking to investors that want to negotiate a valuation for your business, right? Which is also the strongest use case we finance. We call it growth to profitability. It's usually the business that has reached the few million revenue, can start at 1.5, 2 million, right? And FYI, we also finance way smaller. So there's also a way for businesses to finance up to 200,000, and it only takes like a few days to apply because it's a very small ticket and we rather go for mass, right? But if you go on the real, we understand the use case situation, then the strongest use case is bridging or putting a company in an independent state financially. Let's put it that way, or dependent from us to a degree, but independent from equity investors. Because then from that position of strength, you can decide how you want to raise. You basically raise at your terms, not at the investors' terms. That especially also goes for internal rounds, right? Like internal rounds often are also at very bad valuations, and the investor will always take their share, right? So I think it's just important to set yourself up, and that is maybe one of the biggest takeaways for me. Talk to everybody early enough and set yourself up with all the options you have so that you have the strongest position to, in the end, have the best result for the business, whatever you kind of pursue, right?
I see. Well, there's also like a lot of stuff to talk about. Starting from the end, it's also like the concept of default alive that I remember I learned it 3 years ago when Y Combinator sent an email to all their startups saying that the end of the world was coming, the end of free money was coming, and that they had to always have a default alive option. And this is to me one of the keys of why you guys are successful. Like if a business is truly recurring and have a few million revenue, even like 2, 3, they can be alive if they want. You know, it's usually like okay, I mean, I'm not saying that it's pleasant, but like, okay, if you reduce your tech team and maybe even your growth team, then yes, then okay, now suddenly you're profitable because on the revenue you can count and you have way less costs. So that is partly why you guys, in my opinion, it makes sense. Like if you find the right type of business, like you said before, then those businesses are not going to fail because they can avoid failing. So that makes total sense. And also, by the way, we have seen many clients that they needed to make those cuts in the team, and then they kept growing exactly at the same speed, which means that there is a lot in startups. I think there is a lot of confusion of like, okay, we have infinite work to do. And that is true, by the way. There's an infinite amount of work to do. But then like just spending, maybe it's like super inefficient many times. So like, okay, would I be selling 10 times more if I had 10 times more salesmen? Well, maybe not. Maybe not because of a billion things that I can think of. So that's something that to finance that gap, to decide how far you want to be, but without the problem of failing, I think that's where you guys can fit, and we have seen that use case a billion times. And also, by the way, I found it also interesting the charts that you showed for the alternatives. So peaks, those peaks are either equity that you are raising at the current valuation that you wish you would have raised on the coming months. You know, ideally you would raise a funding round per month to finance each month. As it is so painful, you're raising all this money, but at today's valuation. That has a huge cost, like we said at the beginning. And if it's a loan, I'm sure that you guys have had the comment of yeah, like we can cancel with you, but for 2%. Whereas a loan, I don't need to pay any repayment or whatever. It's like, no, you're paying interest from all the money from day one, and for a long time it's gonna be sitting in your bank. So that,
Yeah.
like, I understand where you fit. And by
And
the
I
way,
think
oh,
I
sorry.
think one of the yeah, sorry, one comment. One of the very like impressive calculations, I think, if a business grows with, let's not be too aggressive, like 2-3% per month, right? Maybe even 4. If you are only able to raise money 6 months later, what is that going to do to your valuation? It's so crazy how much money you save if you are able to like leverage, even in like, you only need 5 months of runway. It's not that much money for the average business, right? But even if you are on a healthy path and you are like not healthy, but even if you're on a strong growth path and you want to raise the next equity round, I think raising it a bit later and raising it with a bit more cash is always a very good idea. And the math makes a lot of sense. It's just a question of, do I do the math and do I want to engage in something I haven't done before, or do I just do what I did before and go to the investors, right?
That's true. I had never done that math, but like any of our clients, without exception, they would say they're gonna grow more than 4% per month. You know, it's like, wow, it sounds so low. Then for 6 months, that's more or less like 25%. Then 25%, if your valuation goes according to your revenue, which very often it does, it would already be like a discount of 25% in the round. So yeah, like, I mean, I understood the concept, but I had never done the 4%. I think that's pretty powerful when you
And
actually do the math.
And the funny thing is, once we built a calculator for this, because initially when we did our product market fit and we tried to explain to people why they should use our money, and really nobody was using debt in Germany in the like VC startup scene for SaaS. We built this calculator and it's just math, right? Like you put in the valuation, you put in the percentages. If you ask any, if back then, if you asked any company you've been speaking to for their numbers, what they expect, the results were so ridiculous that you couldn't really use the calculator, right? Like it's like it didn't really bring us a big benefit because it just seemed like a ridiculous, too good to be true argument. I think in a degree, it's not that simple, right? You do get another player on board. It's another party that has interest in us, right? But in general, I think it's true, right?
Yeah. No, no, it makes total sense. I always say that past usually predicts the future. So like I don't change the KPIs that much for the future. And by the way, it's 6:28. So if there's any other question, please write it on the chat, and we'll have time. But while any of you guys may be writing it or not, like, did you guys think of becoming purely a credit line? Because I guess your objective is to be used exactly as needed, which essentially is very similar to a credit line. And then I guess there's not so many operations on like many loans that combine such that you create that height to fly above, more or less. So like, have you considered it?
I think we are going in that direction. Especially now we've changed the product a bit lately. Who doesn't know it doesn't see it, but the repayment early, like back in the days, the repayment had to happen over 12 months. Now the repayment can happen instantly, which is a big change in that direction. I think also from my perspective, right? If you finance a new company and you want to understand on their performance, you do invest quite some time. So you wanna get to know the people, you want to get to know their idea, you want to score them, which happens actually mostly automatically on the platform. So that part is not that crazy in regards to effort, but there needs to be a certain minimum commitment to us in whatever we do, right? We want to make sure that all our efforts we put in, they are actually, they pay off. Plus, if you make it super flexible, like in reality, we don't see people making use of the full repayment a lot. It's usually when a company is being bought, then maybe they do the full repayment. Otherwise, it's just super nice to have the option. So for us, it's actually very cheap to offer that because it's super high value for the company, but most companies don't use it. So it's actually acceptable. I think we had like 3 full repayments this year, which is not a lot in regards to the portfolio that we have. So and no, actually it's just 2 this year, but never mind. So it's just a few. And I think to the real 100% flexibility you're mentioning, I don't think we are going to go there, but I also not today, right? Because if I circle back, actually Recap is a platform that offers different funding options and based on insights that we generate, and we offer the insights themselves. So first and foremost, I think what companies will do is they come on the platform, they use it. It's actually quite cheap. It's plug and play. You connect your bank accounts and you get the liquidity analysis. So everybody feel free to try it out. It's for free initially. And then you, like 1 minute after you connected the bank accounts, you see all the analysis. Like it builds a full cash flow forecast, cash flow analysis going backwards. It builds forecasts on revenue and so on. It's really nice. But that information can be used to score companies and to give other people that want to invest in companies, let it be debt, let it be something else, the quality of the business. So I wouldn't consider us a funding provider per se. It's just that this is the one facility we are now using what we've been talking about, but there might be new funding options, including subsidies, including other stuff like long down the road. That's not on our short-term roadmap, but we are the platform that kind of combines all corporate capital operations, right? Including the funding of it. So long answer to short question. I think we might go there, not today, but today we are already close enough so that every SaaS startup, I think, has nearly the same experience in regards to efficiency. Because usually it doesn't, like if the business model is not super seasonal, then you don't really have those crazy jumps, or not even seasonal, but even on a month, it needs to be on a monthly basis that you have those crazy jumps where you would need it, you know?
Perfect. Yeah, and I guess with all the data, you guys can provide the advisory on like, okay, if you want to maintain this, this is the amount you should raise now, and like help control the cash flow completely. That's super nice. Well, I guess time's up. I mean, I think like some of the short sentences we made can be made into a webinar by themselves. So certainly, I hope it was interesting for the audience, and certainly to me it was. So great having you, Lucas. Thank you very much for your time.
Thanks, Jaime, and thanks for everybody coming. Have a great evening.
Exactly. Yes. Thanks everyone for joining, and I guess we'll upload this to YouTube as well to be available in the future. Okay. Thank you very much, everyone. Bye bye.
Ciao.